The stock market. Everyone talks about it like it's a magical money machine, but to me, it just looks like an angry, glowing neon heartbeat. Seriously, what do all these financial buzzwords even mean? It feels like a secret language designed to keep my wallet empty. But don't panic. To understand the stock market, you don't need a math degree. You just need to imagine a giant, chaotic marketplace. Imagine a massive bakery in this market called super tech. They make the most popular pies in town, but baking them costs a fortune. To raise money to grow their business, the owners decide to slice their massive company pie into thousands of tiny, bite-sized pieces. Each piece is called a share of stock. When you buy one tiny slice, congratulations, you legally own a piece of that bakery. Granted, it's a very, very small slice. You don't get to tell the CEO what color to paint the break room. But as the bakery makes more money and sells more pies worldwide, the value of your tiny slice starts to do something awesome. It grows. Because more people want a taste of super tech, the price people are willing to pay for your slice goes way up. Suddenly, everyone in the marketplace is shouting, "Hey, I'll buy that slice from you for double what you paid." If you sell it to them, boom, you just made a profit. That is the core of the stock market. Buy low, sell high. But what if the bakery has a terrible year? What if they drop the pies on the floor, or people realize they taste like cardboard? Your slice shrivels up. Now, nobody wants to buy it. The value plummets, and you're left holding a sad, moldy piece of nothing. If you panic and sell it while it's moldy, you officially lose your hard-earned money. That is the dark side of the market. Risk. So how do smart investors avoid getting stuck with moldy pie? They don't just buy one bakery, they buy the whole grocery store. Let's talk about diversification. Okay, so buying the grocery store means buying an index fund, or ETF. It's like a pre-assembled shopping cart. You put a tiny bit of money in, and you instantly own bits of hundreds, even thousands, of the biggest companies in the world. This way, if one tech bakery catches fire and goes bust, the other thousands of bread makers, soda bottlers, and toilet paper manufacturers can make up for it. But wait, there's a bonus. To incentivize you to hold your slice, some companies give you dividends. It's like getting a thank you note in the mail, except the thank you note is made of actual cash. Companies sometimes share their profits with their owners. That's you. This is called passive income. You get paid just for owning the slice. Ah, the good life. But here's the thing. Market investing isn't a straight line up. You need to prepare for its moods. In a bull market, everything feels awesome. Stocks are charging up like this majestic beast. Everyone is confident, investing is easy, and you feel like a mathematical genius. Until a bear market happens. The charging beast trips, values fall, and everyone gets scared. This is when the panic we talked about earlier happens. People sell everything. The key isn't to get scared by the bear. It's to understand that the market always cycles, and history can tell us why. Let's take a look at the biggest bear of them all. Welcome to the 1920s. The economy was roaring, and the stock market was the biggest party in town. People weren't just investing their savings. They were borrowing massive amounts of money from banks to buy stocks. It was a giant bubble. Then came Black Tuesday. The music stopped, the bubble popped, and the market completely crashed. Because everyone invested with borrowed money, they couldn't pay it back. Banks closed down overnight. This triggered the Great Depression. Years of economic hardship, all because people forgot about basic market risk. But here's the ultimate lesson. The market recovered. It always does, as long as you play the long game. Fast forward to today, you don't need a vintage ticker tape machine or a fancy floor broker to buy a piece of the pie. Now, anyone with a smartphone can trade stocks, crypto, and meme assets in a single tap. It's the ultimate democratization of finance. But beware the hype. When you treat the stock market like a casino, it can wipe you out just as fast. So how do you actually win? Golden rule number 1. Never risk the money you need for rent, groceries, or emergencies. Rule number 2. Patience wins. Let consistent, long-term investing and compound interest do the heavy lifting while you literally sleep. The stock market isn't a mysterious monster. It's just a tool. Grab your piece of the pie, stay smart, and hit that subscribe button for more breakdowns. See ya.